Hello and welcome. So I'm on this problem, number 154 on page 59 of your course pack. In this lecture video, we're going to be continuing doing extra practice problems. On November 1st, J Company loaned an affiliate $100,000 at a 9% interest rate. This is a note receivable. Okay, so note receivable plus interest will not be collected until March 1st of the next year. So we loaned money. Okay, we loaned money to someone else on November 1st. The company's annual accounting period ends December 31st. So what we have to do on December 31st is we have to record 2 months worth of of interest. This isn't rent, interest revenue. We have to record 2 months worth of interest revenue. So the first thing I want to do is to calculate how much interest revenue I'm going to receive. And this is not interest expense. So you can see right off the bat, there's no interest expense because we're loaning money to someone else. We're not taking out a loan. So we are receiving interest revenue, not paying interest expense. Okay. So you have to figure out how much. And the way we do that is we take the principal, which is our 100,000, times our yearly interest rate, times the fraction of the year for which we have the loan. Well, our interest rate is 9%, so 0.09. We have the loan from November 1st to December 31st, 60 days, 2 months, divided by 360, which gives us 1,500. So what we need to do is on December 31st, we have to recognize that we have earned $1,500 worth of interest revenue. Okay, we have earned $1,500 worth of interest revenue. So you can see right off the bat, A is not right because it's 750. D is not right because it's too much. The right answer is going to be E, debit our interest receivable and credit our interest revenue for $1,500, okay? The way I got that again is by taking the principal times the yearly interest rate times the fraction of the year, 60 days, divided by the 360 gives me the 1,500. And again, this is not interest expense. We have loaned money to an affiliate, so we will receive interest revenue. Okay? So let's look at number 183. So it says right over here, a company has 20 employees who each earn $500 per week. That begins on Monday. December 31st is a Monday, and all 20 employees work that day. So if you see over here, they earn and then they begin on Monday. So they work this Monday, which is December 31st, but they're not going to be paid until later. So what we have to do is accrue their salaries expense for 1 day. We have to accrue salaries expense for 1 day. That means debit salaries expense, credit salaries payable for 1 day's worth of salaries. So we have to figure out how much that is. Well, we got 20 employees who each earn $500 per week. So this would be their total for the week, right? 20 times the 500. And then as for 1 day, let me just say 1/5 because it's 5 working days in a week. So times 1/5, which gives us $2,000. So our journal entry would be debit salaries expense, $2,000, and this again would be on 12/31. Credit salaries payable, $2,000. That would be our journal entry on 12/31. Now, let's look at our journal entry on January 4th, which is when we have to pay them of the next year. So we have to pay them on the next year. So you should know right away, right, that we're going to credit cash because we have to pay them. So we look over here, how much are we going to credit cash for? Remember, it's our 20 employees times a $500 per week, which will give us our $10,000. So we know we're going to credit cash for $10,000. And we no longer have this salaries payable because we're paying them for it. So we don't owe them that money anymore. So our liability goes down. So I'm going to debit my salaries payable for my $2,000. And then I'm missing a debit. And how do we know we're missing a debit? Because remember, debits have to equal our credits. Total amount of debits have to equal total amount of credits. Debits are 2,000. Credits are 10,000. This is not a valid journal entry yet. So I'm missing a debit. And what do you think I debit? It's salaries expense. Salaries expense. Okay? So I debit salaries expense. And how much do I debit salaries expense for? Well, it's 4 days, right? 4 days times so if I multiply 20 times 500 times 4/5, because it's 4 out of 5 days, because we did the first day and the prior year, that gives us $8,000. Or you could take the 10,000 minus the 2,000 to back in to figure out it's the 8,000. Okay? Let's look at number 188. All right, so look at this first one. It says estimated depreciation on office equipment for $4,000. This is going to be on 12/31. This one's an easy one. We debit depreciation expense for $4,000. And then we credit accumulated depreciation, which is our contra asset account, for $4,000. Debit depreciation expense and credit accumulated depreciation, $4,000. All right. Now let's look at this one. Prepaid insurance account has a $3,680 debit balance before an adjustment. An examination of our insurance policy shows that $950 of our insurance is expired. This is our insurance expense. This is our insurance expense. So $950 worth of our insurance expired. Remember, prepaid assets such as prepaid insurance, once they expire, they become an expense. They become a cost of doing business. Just like what we did in some of those prior lecture videos with insurance expense. When the insurance policy expired, we debited the expense and then we credited the prepaid asset or the prepaid expense. Okay? So debit insurance expense, credit prepaid insurance. And that will be our journal entry right over here. 12/31, debit insurance expense. In this case, I'm telling you how much it is, $950. And then credit prepaid insurance for $950. That's our journal entry. So look at C. It says the prepaid insurance account has a $2,400 debit balance before an adjustment. An examination of our policy shows that $600 is unexpired. So in this case, we have to do a T account. Prepaid insurance. And we got $2,400 over there, right? And then we say we got $600 left. And we're looking for, well, how much is the credit for? That's the unknown, right? How much do we credit prepaid insurance, which is how much was expired? This is how much is not expired. That's the balance in prepaid. How much is not expired? This is how much we had to begin with. And then we need to figure out what adjusting journal entry was done. Well, that's to figure out what the credit to prepaid insurance is, which is how much was expired. So how can I figure that out? 2,400 minus the 600 gives me 1,800. So my journal entry in this case is it's still debit insurance expense and credit prepaid insurance. That's still the same, but the dollar amount is different. It's $1,800. Right? It's $1,800. How did I get that? The 2,400 minus the 600. All right. Let's look at part D. Actually, what I think I want you to do is I want you to pause the lecture video and do part D, E, and F, and then come back and check your work, okay? Thanks. Okay, so let's see how you did. The company has 3 office employees who each earn $100 a day for a 5-day work week that ends on Friday. The employees were paid on Friday, December 26th, and worked Monday, Tuesday, and Wednesday. This is similar to the one that we did earlier in one of the earlier videos. So you got 3 employees times 3 days times $100 gives us $900 total. So this is a debit to the salaries expense and the credit to the salaries payable. This is a salaries expense accrual. That's what that is. We're accruing for salaries expense. That's our adjusting journal entry. On November 1st, the company received 6 months rent in advance from a tenant whose rent is $700 per month. So this is unearned rent. Okay, so this is unearned rent. On 11/1, they debited cash, okay, for $4,200, and they credited unearned rent. That's what they did on November 1st. On 12/31, they have to recognize that they have earned 2 months worth of rent. So $700 per month times the 2 gives us the $1,400. So I debit my unearned rent for $1,400, credit rent earned $1,400. The last one, the company collects rent monthly from its tenants. One tenant whose rent is $750 per month has not paid his rent for December. So on 12/31, we debit rent receivable. If you set accounts receivable, that's acceptable. And then we credit rent earned. This is accruing revenue. That's what we're doing. This journal entry accrues revenue. And again, all these adjusting journal entries are done at the end of the accounting period. Okay? That's why they're always 12/31. All right, I'm going to end this lecture video now, and then in the next lecture video, we'll talk about preparing financial statements from the adjusted trial balance. Okay, thank you so much.